Do you have properties in your family trust and you're thinking of distributing, or rather vesting, the rental income in the hands of the beneficiaries who happens to be your children? My name is Shilly Boy. I'm your tax and financial advisor. I talk everything that has to do with tax, financial planning, and property. Yes, you've got a situation where people actually invest in properties through family trust, property trust, and business trust. Now, instead of retaining the rental income in a trust, they actually, on an annual basis, distribute the rental income to the children. But what are the tax implications for that, and what should you be mindful of as the trustees? So now let's actually analyze this. So let's say I've got a student accommodation property, and I'm making rental income, and as far as he's paying me decent money, and I'm thinking, listen, instead of the trust being taxed at a high income tax rate, let me rather distribute this rental income to my children, and my children can travel the world or can pay their school fees, which is brilliant. That's exactly why other people have such arrangement. However, what you need to be mindful of is that that particular rental income, having been distributed, will be taxed in the hands of the beneficiaries. Equally so, that the expenses that are attached, or rather the expenses that were incurred as in terms of producing that particular rental income, will also be allocated to the beneficiary. So that's why it's so important. However, the deductions, or rather those expenses in the hands of the beneficiaries, can only the beneficiary will only be allowed to deduct up to the rental income. Let me give you an example. Let's say I've got two children and I've got rental income of about 20,000. I cannot give let's say I give first child 15,000 because maybe they're at university and the university fees are expensive. And then let's say I've got expenses of say 30,000. I cannot then give the child that I gave 15,000, give them 20,000 of expenses. If I do that, what will happen is that they can only deduct up to 15,000. Then what will happen to that 5,000? That 5,000 that is extra of the expenses will be taken back to the trust and be deducted against any taxable income that the trust has. If the trust doesn't have anything, that expense will be retained, and then only the following year the beneficiary will be able to deduct that expense against any income that is coming from the trust. So that's why it's so important when you do that, because then you can end up disadvantaging the other child. Let's say in this case, then you gave the other child 5,000, and then maybe you give them less expenses to deduct against that 5,000. So can you see that the other child may end up actually paying tax unnecessary? So because you would have actually not did a split carefully. So that's why it's so important to understand the splitting and then understand the tax implications when you are making these decisions as trustees. So those who have the properties in their family trust and business trust, please share with me your experience and how do you navigate these administration processes, and share with me on the comments, or you can send me a WhatsApp. Let's have a discussions. I always want, or for that matter, you're looking at for me a family trust. Let's have a conversation. Why do you even need family trust? What are your aspirations? What are you going to be using this family trust for? Share with me. I'm interested to know. Good luck.